Our panel, who I'm going to introduce momentarily, will be, after the presentation, the panel will critique and I encourage audience participation. The best ones of these events have been where we've had lots of audience participation. So I encourage it. Before we get started, I want to introduce one member of my panel, Governor Pataki. Come on up, you're going to say a couple of words. The governor is currently a colleague of mine, and I'm very pleased to have him as a colleague.
Thank you, Lori, and welcome to this conference. And I'll tell you, I'm really excited about it because 12 years as the governor, you're the gongee. And tonight I get to be the gongor and decide how well the panelists are doing. I am excited to be here, and in significant part, it's because Lori has joined Chadbourne. A number of you have worked with Lori before, and I've just had the chance for the last month or two to get to know her. And I can tell you that it's just a tremendous thing for Chadbourne to have someone with the incredible knowledge in the VC space and the green tech, clean tech area join the firm.
We have this on tape.
The mic was off, you told me. After I was governor, I joined Chadbourne because while I had been governor, we had done a lot in this space, in renewable energy, in nanotech and clean tech. And when I looked at the options, there was no better firm, no better place than Chadbourne. And now it's been a little over 3 years, and it's been just terrific. And I know having Lori here is just going to make it even better. When it comes to green tech, clean tech, venture capital, the first thing you think about, I'm an honest politician, when you think of venture capital is the Silicon Valley. New York, you think of second. But it used to be the same way with nanotechnology. And when I was governor, I went out to the Silicon Valley a number of times. I actually got the Semiconductor Industry Association Man of the Year award one year. And the reason was we stole all the semiconductor and nano companies out of the Silicon Valley to upstate New York and Albany. And you may understand it, but most people don't know. Right now we have a $4 billion capital research facility there with every major global company in the world developing next generation nanotechnology products. And I'd go out to the Silicon Valley and I'd go to these companies and I'd say, it's hot, you have earthquakes, it's expensive. Come here. The climate is better. We don't have earthquakes. And the future may have been written there last century. It's going to be written here this century. And because of you, I hope that that is the case. So you look down. And we do have great venture capital funds and investment groups out here to deal with the companies. And one of the things that's often overlooked about New York is that particularly we've been working with a number of startup, technologically brilliant, but there is technologically risk companies in the green tech, clean tech space. The New York State Energy Research and Development Authority has probably more than $200 million that they will not loan, but they will grant, make investment in green tech, clean tech companies that locate facilities or look to expand in New York State. So as you're looking at the venture capital opportunities, partnering with the VC funds, with the VC groups, and with, maybe there isn't going to be the funding coming out of Washington, but I think there still will be coming out of Albany for some time to enable you to succeed. So this should be a fun evening. I hope the crowd isn't quite as hostile as some I've faced in the past when I'm over there on the panel. But Lori, thank you for hosting this. Thank you for joining Chadbourne, and hopefully we're going to have a great night tonight. Thank you very much.
Real quick, I'd just like our panelists to introduce themselves. And Josh, because he's taking the microphone, is going to go first.
So Josh Wolfe, I'm the founding and managing general partner of Lux Capital. I'm on the board of a company, some of you are familiar with Lux Research, which focuses a lot on alternative energy, and an editor at Forbes, covering the intersection between what I call mavericks and molecules, but the intersection between science and finance. About a third of our portfolio in our current fund is energy and materials related, or clean tech and green tech if you prefer. prefer. That ranges from companies doing high-tech treatment of nuclear waste, companies converting coal into clean fuel, company actually in upstate New York doing deep UV water purification using LEDs, light-emitting diodes, which is the world leader in that space, and a company in Southern California doing gallium nitride power semiconductors, which we think if Intel was for digital logic, these guys will be for digital power.
Thanks. Hi, Stella.
Hi, everyone. My name is Stella Grizont, and I'm the market director of Ladies Who Launch. Ladies Who Launch is a corporation working with over 100,000 women entrepreneurs across the US and Canada. And our mission is to really empower women with the resources, connections, and tools they need to launch their businesses. Women are launching at twice the rate of men, and it's a real force that we need to recognize and support in order to move our economy in a new direction. In my other life, I have two. I also work as a partner for Living Breathing, which is a brand strategy and digital firm.
Thanks.
All right, my name is Steve Brotman. I'm the founding managing director for Silicon Alley Venture Partners, which is a venture fund and a division of Greenhill and Company. And we manage about $100 million. We focus on technology-enabled services and information services, which often are incorporated in all parts of our economy, from publishing to advertising to financial services. And I'm spending more and more time focusing on how software and IT impacts the green tech world. And to find those types of opportunities, we find that the best opportunities are often in IT. So I'm looking forward to this panel and the presentations.
Hi everyone, I'm John Cote. I'm with GE Energy Financial Services. EFS is one of the smaller GE capital businesses. We hold about $22 billion in energy investments worldwide. I manage the smallest portfolio in our division, which is our venture capital portfolio. We have about $200 million invested in early stage emerging energy technology companies. And the role for our team is really to serve as energy technology scouts for GE. So GE has a huge R&D, global R&D facility up in upstate New York, one of our locations up near Albany. And we're out in the market tracking early stage companies and making early stage investments to either assist our research division or our commercial division.
Thanks. And thank you all in advance for being on this panel.
My name is Ken Baxt. I'm the Chief Financial Officer of Global GSE. I'm joined by Dave Monroe, our CEO, and Bill Talmadge, our Chairman of the Board, and Andre Mack, who I will introduce in a little more detail, hopefully not 10 minutes into my presentation, because he has a few things to go through as well. It's an honor to present, and Lori, thank you for inviting us. Global GSE, which stands for Global Gold Standard Credits, is setting the standard in mobile performance and emissions measurement. We are an emission measurement and credit generation company specializing in the mobile emissions sector. Taxis, buses, trucks, trains, ships. We can actually measure the actual emissions coming out of the tailpipe of all those moving vehicles in the real world, in real world conditions. The company's mission is to create value for large fleet operators by accurately measuring vehicle performance and providing advice on vehicle improvements to reduce costs and emissions. Until now, there's been no way to accurately test vehicle performance during real-world operations. Absent this information, operators have had to rely on manufacturer data, all of which now is historically unreliable. And this has made it very difficult for operators to make improvements and to meet compliance requirements. We have patented EPA-verified portable emissions monitoring system, which facilitates accurate measurement of fuel usage and emissions, a variety of emissions during real-world operations. So as you can see, this is a small suitcase. It weighs somewhere between 18 and 30 pounds, depending on what pollutants it is measuring. And it will go on the vehicle and travel with it while it measures what's coming out of the tailpipe. It's lightweight and truly portable, measures carbon, dioxide and monoxide, nitrogen, oxygen, hydrocarbons, and particulate matter. It is GPS based, so we know where a vehicle is at any second in time and what its emissions are at that time, as well as its fuel usage. Fleet operators throughout the world are facing increased fuel costs and pending emission reduction legislation. Many of the largest transportation companies are already working to voluntarily reduce their carbon footprints due to market pressures. The portable emission measuring system can assist these organizations in identifying, implementing, and monitoring vehicle improvement programs to reduce costs and to meet compliance requirements. So, fleet procurement investment programs, when we say testing new vehicles to assess real-world performance before large-scale deployment, we can test an existing vehicle's emissions and fuel usage. We can test the replacement vehicle's fuel usage and emissions. By way of example, same driver, same route, to determine the delta before large-scale deployment is made. So we can help companies avoid spending a lot of money on technologies that don't do what they think they're supposed to do. Same concept on add-ons. Any new technology or modality, we can test an existing vehicle traveling and then measure it with the add-on or with the change in modality to determine the delta. And then finally, we can measure and report for precise emissions with recommendations for improvements and compliance. Our approach to the market is to initially concentrate on large fleet operators where our technology can add significant value. We can test a small number of vehicles, and that value can be translated across their entire fleet. Create revenue-generating measurement projects to assess and develop fleet improvements and identify emission credit opportunities, which Andre will get into in a little bit. And that's kind of our long-term, I think, great opportunity there. And build out business systems and relationships with partners to create global reach. And in that case, we're thinking large accounting firms, consulting firms, and fleet service organizations that are already servicing the very fleet owners that we can provide an invaluable service to. So our long-term revenue model is to apply that knowledge and relationships to dominate the mobile emission reduction credit markets as and when they emerge. So you read about cap and trade and flat tax and other ways of trying to control emissions. They say that the mobile sector of carbon emissions worldwide is somewhere between a quarter and a third of that total market. So it's a huge market opportunity. They say by 2020 that carbon emissions are something like $5 trillion. So that would put the mobile sector on that somewhere between $1 billion and $2 billion. $1 trillion and $2 trillion, excuse me. So at that point, what I'd like to do is turn this over to Andre Meck, who is an expert in emission reduction credit markets for over 10 years, and he's been advising us on that aspect of our business. He was invited to critique the ISO 14064 standard, which is the backbone of all emission reduction credit programs. Andre was one of the first 18 people in the world to pass the ISO 14064 exam, which enabled him to write emission reduction credit projects under that standard, which has been now adopted by the United Nations Framework on Climate Change. He's written more than 50 emission reduction credit projects. Almost all of them were stationary, forestry, power plants, and he'll tell you why there have been very few in the mobile sector written. He was invited by the Alberta Offset System to write their mobile emission reduction credit protocol, and he recently appeared before the Canadian Senate to explain cap and trade to them. So with that, Andre Meck.
Super. How much time? 4 minutes. 4 minutes. Okay. Thanks, Ken, for that introduction. When I spoke to the Canadian Senate, I did it in the G8 room, and so I sat in Margaret Thatcher's chair, Ronald Reagan's chair, Mikhail Gorbachev's chair, Francois Mitterrand, and when the people came in, they said, well, who's this guy, Andre Meck? Well, now you know, because Ken told you. This is a very exciting technology, and what PEMS does, which hasn't been done before, it brings the laboratory to the field. Okay, before you would test in the lab, and then you throw the vehicles out in the market, and then whatever fuel efficiency you get or whatever comes out of the tailpipe, that's what you got. Right now, the PEMS is a laboratory in a box. So it's something about this size, and it travels with the vehicle, and it tells you exactly what you're doing and exactly what the change is. The ability of PEMs to generate carbon credits has been acknowledged by the UNDP. When we worked in Egypt, the UNDP wrote in to the contract that they owned the carbon credits generated by this. We wrote it out. De facto, we got it. So that opens up all sorts of opportunities for us. PEMS provides highly accurate and reliable data, a key component for all greenhouse gas programs. If you don't have reliable data, and this is very exciting, you have to discount and discount and discount to give credibility to the product. With the laboratory in the box, now you don't argue about whether it works or not, you argue about whether the data or the margins of error on the data. This is hugely exciting, and this is why there was no mobile emission reduction sector in previous legislation. Very exciting. Right now, PEMS has few competitors, minimizing margin eroding competition. Right now, we're the only people with a box under 20 pounds in the world. PEMS has many suppliers keeping input costs down, so we can negotiate low margins to put the material in the box. Buyers have a need for highly accurate data keeping, PEMS, product value high. Emissions targets and caps are coming to Europe in 2012. That's 14 months. 14 months, and the caps are there. What follows? Trade. Mobile emission market participants will pay an excess emissions premium. That's written right into the European legislation if they exceed targets. My feeling is that the Europeans won't meet their targets. They'll go to the CDM to try and get credits, and we're already approved by the UNDP to operate there. This is very exciting. This is what we do. This is the same truck, same vehicle, same day, 3 different technologies. You can see the top line is just the truck running without anything. We put another technology in that did that profile. The bottom line is another technology. The difference between the top line and the bottom line, that's a credit, and you can measure that and you can evaluate it. So we got 1 more minute. That's it. So global GSE PEMS, we got the product. There's a need. We have patent protection. We've created barriers to entry to the United Nations, and we can bring high quality data to support the creation of mobile carbon credits in the emissions reduction sector market. This has never been possible before. It is possible now. This is a New York company, and we want to bring that value added to New York State, Long Island, unfortunately, but not. Okay. Governor Pataki, honored board, guests, thank you very much. It's been a tremendous opportunity. I love speaking to New York.
A suggestion and then 2 or 3 quick questions, and you can answer maybe 1 of the 3 questions and take the others home to think about. Suggestions, I think you have an opportunity because you know they say that you can only manage what you can measure, and you have an opportunity to present to people the capability to measure something that maybe they couldn't before. And so really dial up the cost proposition that you might be able to save people on the fuel side. Really dial up the ability if you can get a good housekeeping seal of approval, the Robert Parke or whatever it is on car emissions, that should be a sticker thing, you know, associated and branded by you guys. 3 questions I would have. Pricing, how do you think about the pricing of what you would charge the fleets? Adoption, how do you think about getting that first fleet? What's the persuasive pitch that's going to get that very first fleet? And then the third, which is really a tough one that I think investors are going to struggle with, is how do you think about the shifting or the inevitable shifting regulatory winds? It's what may be required in 2 years. Budgetary concerns may make it disappear.
Just one quick point before we get into that. The backdrop to that is that this technology was invented 10 years ago up in Buffalo. Somewhat typical inventor company, went 10 years, not a great business plan. They thought the value was in selling boxes. They sold some. They didn't recognize the value of the data. And that company, Clean Air Technologies, Inc., has been merged into Global GSE. It just happened this summer, and we are just rolling out. And so we're in the process of now determining how to price that product. Initially, when legislation was at what appeared to be a more positive trend, it has gone sideways at best. Short term, we determined that it would be better for us to approach it from an income producing model where we were helping fleet owners on a pay basis while we're establishing relationships with those very owners to help them long term write their credit projects. So that's there. The pricing model, whether it really depends on what we're measuring and how much we charge per day to test, how much are we testing, how many vehicles, is it an ongoing project. Does it go for a whole year? Does it go for 30 days? Are we testing 10 buses or 1,000 buses?
Excellent, thanks.
First fleet, and just to answer your question, first fleet, I mean, obviously we have our eyes set on the FedEx, the UPS, the Verizons, the Caterpillars, you can go on and on in terms of Walmart. These are companies that have fleets of thousands, tens of thousands of vehicles. That's where we can add a lot of value. I don't know what the third question was, but.
Two questions. First, really following up on Josh about the public policy thing. I don't think the U.S. is going to develop a cap and trade or pricing of carbon law for quite some time. And you talk about the need for the market to emerge. To what extent, in the absence of a national U.S. market, is your business plan viable?
I think we could have a long discussion about whether you can wait for the rest of the world to move ahead. I think that the rest of the world will move ahead, and that the United States will have to follow on just to maintain competitiveness. I think there's a real need for people who are 40 years and younger to address this problem.
But in the absence of a U.S. market, does your model work?
The model works in the absence of the U.S. market, okay? And there's two routes to entry. We operate on the voluntary market to prove concept.
Right.
Then we go through the UNDP to develop the concept and to formalize it and do some test sales into Europe. And then we go through the CDM, formalize the protocols, and then enter Europe full steam ahead. So that is a standard engineering process. Jump the chasm, develop a test market, prove the concept, and then go full steam ahead. So the model is extremely viable. It's just, where are we going to start?
And then the second question is, if I'm a fleet manufacturer of some sort of van, delivery van for Walmart, I am going to do my own testing. And if a company is going from van A to van B and thinks that they can get carbon credits because van A has this emissions profile and van B has this, you don't need to have these on very many vehicles. The OEM can put it on their vehicle, test it, and then get certification so that it limits the need to have more than just a handful of these deployed.
It's always the end use that matters, okay? The end use is what is going into the atmosphere, and that's what has to be tested. So you can do this fundamental testing at the OEM, but after that, any kind of a credit or a benefit is going to get discounted and discounted and discounted, as we know, because our vehicles don't perform the same way they do at the OEM's test track. So this is going to start being used at the OEM, and then it's going to be used again by the end users again, because the end users are going to go back to the OEM and say, hey, you promised me this, I didn't get it, what's up? And that's going to start to hurt in the future if people don't do that. We did a test where a user was guaranteed between a 20 and a 25% reduction. We tested it, it's a 10% increase. That's a problem.
Well, and another point, I don't want to mention where, but we've tested both diesel and hybrid buses for a municipality, and the hybrid buses weren't doing what they were supposed to have been doing as per manufacturer's claims. So before you go and spend billions of dollars buying a hybrid bus technology that doesn't do what you think it's doing, it doesn't make a whole lot of sense not to use this technology to find out what is coming out of the tailpipe of your existing vehicle and the one that you're going to replace it with out in the world, in real world, driven by those drivers, which is a lot different than the test track. We all know that when we buy a vehicle and it comes off the production line, that the fuel economy that's stamped on that purchase order is not real. We don't get that. And then over time, as that vehicle degrades in performance over years, it gets worse. And so particularly when you're writing credits, it's not even just about what it is when it's new. You're replacing a vehicle that could be 5 or 6 or 8 or 10 years old. The delta is you got to go measure what's actually coming out of the tailpipe of that 10-year-old vehicle, and then what's coming out of the new vehicle or the new technology that's being used to replace it with. So there's a value there. The bottom line is, a large fleet owner, for, if you think about the value added and the cost that they would incur to have us do their testing, to help them determine what should they and shouldn't they buy. Very difficult decisions for them to make in a vacuum, and very difficult decisions to make based solely on manufacturer data. So we think there's a lot of value added there. Whether or not there's a market here in the United States might not evolve for 2 or 3 or 4 or 5 years. Probably going to happen sooner in Europe. Certainly, it's already slated to come on in 2012. Likelihood is that what's coming out of the stacks of ships, we already know is going to be 50 miles of port. So California is probably going to be at the forefront of using this technology because we've got a rack system, which is essentially a rack of these PEMS units that can measure multiple outputs on a ship. So anything that happens within 50 miles of that port, right now they don't know yet that we have the capability of telling them what the actual emissions are coming out of that ship every second within 50 miles of port. When they figure that out, I would hope and think that California will be the leader to adopt that technology, and then from there, sky's the limit. That's a big market. Ships alone, I think, are, what is it, 70,000 number of ships, 80,000 ships.
All right, we have a brave first question out in the audience.
And I'm interrupting to let him ask it. Go ahead.
Both a suggestion and a thought. Following up on Governor Pataki, I mean, we're a nation that doesn't believe in evolution, so it's unlikely that they're going to believe in climate warming. But in Europe, they do believe in evolution and climate warming. Why not go there where they do have these markets? Another challenge in the United States is the fleets of FedEx and UPS are slowly but surely converting to electric vehicles. So I think that your market, as you're developing, is disappearing from underneath you. And finally, having seen the package itself, I think you can go back to Albany Nanotech and try to take that big box and go over there and make a tiny box in one of their 3 football-sized clean rooms.
Actually, the next iteration of product development is a wireless tailpipe sensor. And it'll basically take the emissions readings out of the tailpipe as well as the engine management data that we need to come up with grams per mile, not parts per million. That's critical. And that can be uploaded wirelessly, and we can create a database of what total emissions are. Even with, if you go electric, to the extent there is some form of cap and trade, you need to determine what the delta is. So you've got to measure the baseline technology that's being replaced with electric. We don't disagree that today you'd say you're better off in Europe and other parts of the world than you are in the United States. We agree with that.
Gentleman with his hand up in the back.
Yes, hi. Last couple of questions and some of your presentation, you talked about maybe Europe being the better market for you. What are your barriers to entry in Europe? Have you sought international patent protection? And what about Japan?
Let's just repeat that question. Barriers to entry in Europe and Japan. Did I get that right?
That's correct. In particular, patent protection in those areas.
Well, we have strong existing patents on the technology.
Yeah.
We have strong protection in the US presently, but we are also developing the product in a number of ways moving forward, and new patents are in process. And the products that we will use in the market going forward, especially in compliance, will be highly modified versions, starting from the ideas we got from this box. And as Kenny intimated, we'll be talking about a very small wireless unit that will be pervasive and on every vehicle. And I think one of the things we have to say, regardless of what you believe, you have to measure. If it's going to be cap and trade, you have to measure. If it's going to be compliance, you have to measure. If you want to tax people, you have to measure. Right? Just to pull a number, that doesn't work. We all know that. So we understand that the market moving forward is about measurement, and we will be prepared to exploit any part of that.
Can you guys just quickly take us through your timeline and what your milestones are?
Probably no is the answer to that one. What we've got is, first of all, sorry, I'll get back from that. First of all, we are finalising some of our technical development and structuring based on where the market is in the US in terms of cap and trade how we approach the markets abroad. Our first thing was to do a deal with the UN, which we were very successful in doing. And by the contract we struck with them, we basically got the authority from the UN to write credits under their auspices worldwide. That was a very important strategic move for us. In Europe, the legislation that is about to happen plays very much into what we have in our offer. So one of the things we're going to do is, and it's very important this year, is create the modalities and the business methods that goes with the technology to go to the compliance and the governance and say, this is how you should do this. This meets all the legislation you put in place. So we can lock ourselves into that moving forward. Simultaneously, we are building a revenue model by doing what we talked about earlier, by going out and measuring and creating value in fleet operations. And simultaneously, we're identifying where credits exist. When we go in and look at a fleet and we see what the modalities are and where it's going, we can lock that for the future and say, well, we know there's going to be a significant credit opportunity here when the market turns.
Great presentation. In terms of the electrification of vehicles, I think it's my assumption that it's going to take some time for adoption to really catch on, I think, with cost where it is right now and also where manufacturing capacity is worldwide. And so I think you have a real window of opportunity to, with your value proposition. So one comment on your business model. I had a specific question on your business model on how you're planning to partner with fleet services companies. I think I've done a little bit of work with GE's fleet service business, and I think we have 6 million cars under management, and they have a real comprehensive usage monitoring, usage reporting feature for all their customers. So do you, is your business model going to focus on kind of a bolt-on data provider with a hardware sale to how does the relationship look?
That could be one way. What we're doing is we're currently investigating by reaching out to the market and talking to people what are our best options and what are the approaches that make sense to us and to the marketplace. So we're in that process right now of defining the different segments. Again, that is one way we can add some of our technology to an existing GPS optimization service as a plugin. So that is an aftermarket product. Yeah. And we also have an OEM line. So we see different ways we can manifest this technology into the marketplace.
Yeah. Is there a hard ROI? You mentioned that briefly for if a fleet adopts. We're an investor in a fleet management that tracks location of vehicles. So I'm familiar slightly with that space, and I strongly encourage you to talk to those types of companies that are already provisioning technology and can strap on your technology to what they're already doing, so that they actually go in and say, hey, you have a $200,000 asset, why don't you spend $2 a day to make sure they're not staying at the, hanging out at the McDonald's for 4 hours while you're paying them and while your asset is sitting there doing nothing. So is there a similar economic, hard economic proposition for monitoring emissions, or is it only once there's a cap and trade that there is an economic proposition?
That in the US, that's unclear right now. Within the last few days, the EPA put out a number of new numbers, of attainment numbers for cities, and I think it's going to put every single city in America out of attainment. Now, what does that mean? They're going to have to figure out how do we resolve this. And I think somewhere in there is some kind of fee-based model for reporting what their emissions profile is.
But absent legislation capping emissions, this is sort of hard to...
Yeah, it's hard to tell at the moment because it's an evolving picture.
Right.
Keep in mind, pre-tailpipe EDR, right? That strap-on concept doesn't really work.
Okay.
So when the tailpipe EDR is developed, and we think that's going to take 9 months to a year, then there is the ability to either strap onto a GPS service. What they can tell you is they can tell you where a vehicle is, but they can't tell you whether it's what it's emitting at that time.
No, but in terms of, they would be a partner for you, not
Yes,
a competitor.
absolutely.
Not a competitor. I'm just trying to say,
Yes.
you know, if I monitor my car, is there a way for that company to save money today, absent regulation? And if the answer is no, I got it. How much money are you spending every month until that day arrives?
How much money are we spending a month right now?
Yeah.
Before we get to break even, you're asking what our burn rate is on a monthly basis. I'm not prepared to discuss that in this forum.
All right. Are you raising money or?
Yes, we are. We are in the process of raising money. We have raised small amounts of money as required, as we've looked at the opportunity to develop and decided initially before, let's say spring, when cap and trade looked as if it would be passing, it was part of the energy bill. We were going to raise extra money to write a number of credits straight out of the box here. We don't see the need for that in the US, so we would raise less money based on our current business activity.
But if the question is, do we have a fee-based model between now and then? The answer is yes. That's fleet optimization.
Yeah.
That's helping fleet owners decipher what's out on the marketplace, what they should be investing in and what they shouldn't be investing in. I think we would all hope, right, that by way of example, if New York City is going to buy a fleet of hybrid buses and spend billions, or the new taxi legislation, and a lot of money is going to be spent there, that we do some level of testing to make sure that what we're telling people they should do and what we're spending money on, our taxpayer money, that it's working. And all I will tell you is, next time you drive by or stand by an idling hybrid bus in New York, ask yourself why it's rumbling.
Okay, on that note, I'm sorry, I need to move on to stay in the time frame. And these guys will stay around. You can ask questions and what? Oh, I thought you were.
Except for me.
All right.
Thank you very
All right,
much.
so-
I have to run, but.
Thank you. It's great. Thank you.
Good evening, my name is Takomo Hindra. This is Naeem Hukalala. We're from Skystream Markets. Skystream Markets is building the first institutionally oriented trading platform for the environmental markets. The company's target audience is a group of compliance and financial participants. The platform is a pure agency model that takes no risk and works on a pure commission basis, working as an agent in this market. Our team has a demonstrated track record in building platforms in the capital markets. The founders of our company, as well as our senior management team, were senior managers at a company called CreditX, which was known as a financial technology innovator in the credit markets. During the course of our previous company's history, we achieved a 30 to 40% market share globally of the credit market, of which 60% of the market share was electronic trading. The company was a product innovator, bringing auction technology, fixings, as well as straight-through processing and trade processing technology to that market. The company raised $25 million over 3 rounds and was sold to the Intercontinental Exchange in 2008 for just over $600 million. The reason CreditX had such great success in the market was a iterative product development approach, and we're bringing that product development approach to the environmental markets. The approach involves identifying a single problem at a time, solving it using technology, and then going back to the market and figuring out what the next problem is, solving that. Going back through the cycle, creating a scalable platform that really solves customer and client needs.
So I'd like to speak to you about the environmental markets here in the US. What we have here in the US are called renewable portfolio standards, and they exist at 30 different state level programs. What these are mandates that a certain amount of the power in each one of these states needs to come from a renewable source. And the way you prove that as a utility is by owning what's called a renewable energy certificate. So that creates the buying requirement for a REC. The selling requirement for a REC comes from the renewable power producer themselves. So if you're a wind farm and you are producing power as you normally do, for each megawatt hour of power that you produce, you also create one REC that sits in the registry of at your account at the grid. There's no need of a second verification or any other step. The grid measures the amounts of RECs you have. And you can now sell these RECs for additional profit. So that creates the sales side of the REC market. At the moment, the carbon market in the US is very small. There are some small regional markets, but as they scale up, we have plans for those as well. There are a number of related commodity markets, such as coal and natural gas, and there are a number of future markets that people are starting to tackle. You know, at a basic level, what we have seen is that there is a movement towards using a market-based solution to address environmental problems. This is a very powerful type of movement. This kind of market-based solution really allows you to maximize your resource allocation by getting down to the lowest cost of capital. This graph basically shows you that 60% of our country is already covered by a renewable power standard. And to put this in perspective, at the moment, 1/100th of the power in all these 30 states is coming from a renewable source. That is slated to grow to 1/5 in 10 years. You're talking about an enormous growth rate in an enormous market. Currently, renewable power in this country is a project finance problem. It's not an R&D problem, it's not a technology problem. Renewable power producers need to get the financing to get up and going. And the RECs really allow them to fulfill that. And currently in the primary market, no mechanisms exist for them to monetize their RECs. In the secondary market, there is very little price transparency, very little liquidity. Basically, no one has a window into what's going on. And so we have created these products directly in consultation with all these desks to address these specific problems. The first one is to create an execution system. This is not a market like the stock market. It's not a live bid and ask type platform. It's really about concentrating liquidity through an auction platform, and also providing the kinds of reports that increases the confidence level in the market. And then the trader processing services that large institutions are used to. You know, it's all about designing systems that increase the level of confidence. If we just have the same 10 guys that are going to trade RECs, that's not enough. We need to attract a broader base of participants, the investment banks, hedge funds. Those are the guys that we have a history of working with, and we want to bring them into this market. This here is a screenshot of our forward technology platform. We can talk about that in more detail as well if you'd like. And you know, we spend a lot of time with our customers. The principal REC producers tell us, look, this primary market is critical. If it doesn't work, we're not in business. There's no power capability at all. The utilities themselves, we would have thought, would not like us, right? We're out there creating competition for their pricing, but they want large liquid markets. To them, the more infrastructure there is, the more they can trade for whatever they need, right? The RECs start off as a basic commodity, and that increases as they trade it structured with power, trade it structured with fossil fuels, what have you. And the investment banks and hedge funds say the same thing. They want large liquid markets to play in. The more institutions there are like ourselves providing these kinds of services, the more they can trade in the market.
I'd like to give you an update on where we are in terms of implementing the platform. We spent 1 year in product development mode, meeting the major players in the industry across the various facets of the market. Through that, we designed a suite of products we would like to launch, of which we have completed the first version of the platform in development at the end of this summer. So we've been out marketing that. We're working on the second version of the platform with product expansion coming out later this fall. Through that effort, over 40 counterparties, major institutions have agreed to onboard the system and use it for their REC trading. We're also in direct discussions with a broad group of industry participants that include the state and federal level policymakers, as well as the national regulators, the FERC and the CFTC, about making sure that the system has the right requirements for trade reporting as a repository and for risk management. Just to give you a sense of the customers so far that are looking at onboarding the system, we are talking to the major investment banks. There's about a half dozen of them which are active in this market at this time, and this is, you know, the likes of Barclays and Bank of America, etc. Renewable power producers, we're talking to the largest power producers. Some are public companies in solar, wind, and geothermal. Others are affiliates of large utility companies, both based in the US and in Europe. And then some are also upstart renewable producers, which are building utility scale and large scale renewable power plants. On the utility side, we're talking to all the major utilities that have a legal requirement to buy the credits. This includes, in our area, participants like Con Ed and PSEG and Dominion Power, Duke, etc. And on the energy commodity trading firms, these are guys that trade a lot of power, they trade other commodities. They see the renewable energy market as a cousin to what they're currently doing. There's also a number of hedge funds that are active in this market. Just to give you a sense of how this market can grow, currently it's estimated that 1 billion of renewable energy certificate contracts will trade in 2010, growing to 55 billion in 2020 by the requirements. So if you add up the requirements in those 30 states, that's what it looks like. We have a commission-based model. Currently, this market at $1 billion of notional could generate about $30 to $35 million of revenue, total pie, growing to over $500 million by 2020. The implementation of a national market would increase the size of the market from these figures. Just to give you a sense of that, today we have a market where approximately 81 million RECs would trade at $1 billion, growing to 5.4 billion under a national market scenario, and growing to 2.1 billion over 10 years under a regional market scenario. In other scenario, you see a lot of growth in the market.
So in terms of the funding requirement, currently we've seeded the company up to launch. We're looking at a $4 million Series A financing that's really geared towards giving us a 2.5 year launch capability, with full costs across all the regional markets. We have modeled it such that we can reach cash flow break even and build a very sustainable business on just the current state level programs. We do not need the national program to succeed, although that would be a good thing. And apart from that, I'd like to just say, in financial technology, really, we have a track record of success. The three things we've seen work are having the right team, the right approach, and access. We have a great team that we worked with in the past. We're glad to have them. We have approach is really working directly with the traders, offering what they want for the services they need right now. Well, I'm out of time. Thank you very much for your time.
All right, questions. Who wants to start on my panel? Go ahead, John. Great.
Great presentation. Before I joined GE, I was with FPL and managing 2,000 megawatts of wind in Texas. And so in my forecast every year, I'd have my RECs in my top line. And the first year they were at $15, the second year they're at $5, the third year they're at 75 cents. Can you comment on supply-demand balance? And I would assume there's a huge REC buildup right now from all the different renewable energy producers because the demand hasn't been there.
It really depends on the specific REC program. So within the larger REC markets, such as PJM and NEPL, which are the largest, most liquid markets, one thing on my graph I was going to point out is the market is broken up by the way the grid itself is structured. And in certain parts of the states, there are undersupply, especially in particular carve-outs like solar. That's where you hear a lot about that market. So prices there range from $450 in Massachusetts to $600 plus within New Jersey. Most of the other RECs trade around $11 to $15. It's really, most of these state programs are just starting right now. So perhaps what you saw a lot was really from the voluntary market, which tends to be very, very small, and especially without a carbon market coming around, a lot of the people were trading in the voluntary market to be grandfathered into a carbon market. The US carbon market is years away at this point. But the prices are starting to increase, and it really depends on an inflection point of how much power comes into the grid.
Right, yeah, ERCOT is different from PJM.
Texas is its own part of the grid,
right.
Yes, exactly.
One more question. With the explosion of energy efficiency innovation and smart grid innovation, do you see that as having an impact on your market? From a utility, I guess that was one of your major partners and customers that you were looking to as utilities. Do you see that as eroding your potential market opportunity?
We think it's actually an additional opportunity, because if you look at the way they're proposing a national program for renewable energy, they're considering putting about 20 to 25% of the requirement eligibility on energy efficiency credits. So we think that may create a fungibility between the renewable energy certificates and the energy efficiency certificates, which gives really another source of credits that could be transacted on the platform. The way in which they're transacted may be a little bit different than renewable energy, but they're going to be purchased by the same audience, They're also going to have fluctuating market values. So we think it's a close parallel market that will probably get integrated into something similar.
Actually, my fund was an investor in Yellow Jacket, which is a sort of a clearinghouse for derivatives, and it was bought by ICE a couple years back. It was a mere $100 million sale, but we're only in the company for 17 months, so I wish you yet again that ICE, lightning strikes 3 times for you guys. You know, you're similar to sort of the question before about sort of how long do you have to wait for the regulations to catch up for what you need to do? You're talking, maybe I'm just not familiar with your market. There's some voluntary trading, and you said New Jersey's trading some stuff, and Massachusetts trading some stuff. Can you guys exist on this sort of voluntary market? And or are you is this just more from an investor perspective, it's sort of an option. We'll give you some money, and if it happens in the next 2 or 3 years, then yay. But if not, you're out of money, and you need to go raise money from somewhere else.
We've looked very carefully at the regional markets, and the 2 most liquid regional markets are really the Mid-Atlantic PJM market and then the New England market. Within those markets, there is a very significant growth trajectory already mandated in the states in those programs. That provides an opportunity to build a sustainable cash flow in the $2 to $3 to $4 million range, depending on how much market share we get. And we can control our cost base. It's a pretty capital efficient business at this point. Developing IT, has a cost, but it's a relatively contained cost, in today's market. So, as long as we can build a reasonable cash flow, we should be able to sustain our markets in just what exists today. A big part of the growth will come from greater cross-trading in the different regions. And as that starts to take better shape, I think it'll present more opportunities for technology. So the greater regionalization of these markets, I think, will also help us with the ability to have a greater uptake in volumes, a secondary market, potential revenue. And then all of that really comes into much greater play if there's a federal market for renewable energy and efficiency credits. So I think to answer your question, we're confident in the existing markets. We can build a sustainable cash flow that can support the business. It does get a lot more interesting under a federal scenario or as the markets grow.
Okay, there's a question in the audience. Go ahead.
Yeah, I love the business. I'm worried, how are you going to beat Goldman and Google once the national market finally arrives?
We act as an intermediary, so Goldman is a customer of ours, as would any company that principals risk. We do not principal risk. We simply provide them the tools that they need to transact. So we are not in competition with hedge funds. We don't take spread. We don't take a position in the market. We just provide the tools to make the market liquid and as large as possible and as transparent as possible. So we welcome as much participation as we can.
Go ahead.
A couple questions. Have you considered licensing your system overseas, and how viable is that? And the other question is related to the previous question. What competition is out there?
In terms of licensing our platform,
repeat the question, just so people in the back can hear.
The first part was about licensing the platform overseas. In terms of licensing the platform, what we've built for the REC market is directly applicable for carbon offsets. We spent a lot of time in the European market to see how they were trading. And basically, if you were a wind farm in Brazil, you would be generating an offset that you could sell to CDM. If you fell under an RPS, the same offset would be called a REC. It's the exact same product. We do have a plan to expand there. That's part of some of the funding that we require. We would love to be able to expand. In terms of white labeling, as a company, we do not really support that business model. We prefer to have a proprietary capability of building technology. And your second question was, I'm sorry, do you mind repeating that?
Talk about the competition.
The competition, yeah.
So right now in the market for transacting these type of credits, there's really 2 types of entities. On one side, there's a kind of low or no technology voice broker option, which are basically guys that telephones that call around and try to match buyers and sellers. This exists in a number of the different trading markets. A lot of those guys have a background in trading power, electricity, some other commodities, and this is something they do on the side. But there's really no technology in what they do. It's really just the old-fashioned way of matching buyers and sellers. On the other extreme, you have exchanges, which are designed and set up to transact highly liquid, highly standardized markets. So you would have a set contract, and then you would have buyers and sellers lining up on price, like a stock market. You could see kind of the inside market. This market, because it's all project driven right now, and it's really project financing, it really depends where the solar farm is, where the wind farm is, who's running it, what the atmospheric conditions are, what the hardware they're going to use is, how it's financed. All that has to be evaluated in determining to purchase the credits from a particular producer right now. So it doesn't really lend itself very well for exchange-based trading. I think if you look at that growth trajectory, somewhere around 2015, 2016, the secondary market would be liquid enough that it could support exchange-based contracts. And a lot of our business model is to make sure that we're involved in the market before it gets there so that we can become exchange-like at the appropriate time. But that's kind of an opportunity down the line. So on one side we have guys with way too much technology, and on the other side we have guys that don't have any. And it's a nice place to be in between, because you can offer products and services which really take advantage of the differential between the two.
Just a quick question to build on that. In bridging these buyers and sellers, there's a lot of education that has to happen. Can you talk about your communication strategy in terms of really building awareness and streamlining this process so that people can use and engage?
Yeah, we do. We have actually, in the beginning we worked a lot with a lot of the environmental groups that were instrumental in shaping policy in this country. So we spent a lot of time with the EDF, with the NRDC, we've spent time with the CFTC, the FERC. We've written a number of white papers on how a market can be structured to prevent market abuse, to prevent problems, to really fulfill the needs of what the regulators require. So we have spent a lot of our time doing that. We don't do it on a mass level. Most people have no idea what a rec is, which is fine. But we do spend a lot of time in DC speaking to the various offices, at the Senate level and so forth, about a national RES. So we have a pretty deep level of analysis and work done on the market. We spend probably half our day doing demos and educating different market participants, so we do that a lot. But we don't do that in a mass way. We're not in the retail market, we're in the institutional market. So if you're a homeowner with 0.1 recs that you generate every year, there are a number of websites you could go to monetize that. That is not our business. But there are a number of guys that operate in retail.
One thing I would just add too, it's been quite interesting for us to interact with a lot of the renewable producers, because as you can imagine, they're very focused on generating renewable energy and using technology to do that. And we spent a lot of time really working with them to help them understand how these markets work, and then also helping them understand how the market can develop and how it can change from where it is today. And that's a big education process. And we do that kind of one-on-one with customers, and they see the technology and they think about how they're trading today, and when they have credits, how they sell them, and how it can evolve over time. So we do a lot of that work. And it's very interesting for us, when we talk to another trading desk and a big utility, of course they trade power, they trade commodities, they know what they're doing. The renewable guys, they're really kind of looking at having a valuable asset that they want to transact for the first time outside of their electricity, which is sold long-term contracts. So there's a lot of educational work there, which is great for us to build a rapport with our customers.
A couple of questions. A great presentation. And as negative as I was on the political climate for carbon legislation, I think the state RPSs are here to stay, and we will see an expansion of RPSs. I don't know if it'll be national, but I think we'll see more states doing that. But on the RECs issue, correct me if I'm wrong here, but there is, as you mentioned, the RECs originally come from they're integrated into the project finance model. And there is a relatively solid primary market for RECs. When you're doing the project finance, you have some concept of what the RECs will be worth. How does that market work, and what's to prevent the people who are involved in that market from moving into the secondary market, and to what extent does that constitute potential competition? And second, again, correct me if I'm wrong, but I believe that what constitutes a wreck changes based on state to state or region to region. Like in New York State, large-scale hydro doesn't qualify. For wrecks in other states it does. And how can you create an integrated market if what constitutes a wreck varies based on the region within which that wreck is generated?
Sure. The first question regarding the primary market, the traditional way that the certificates were sold were bundled long-term with the electricity. So if you were building a solar plant, you would say, okay, here's the buyer for my electricity coming from the solar plant. Simultaneously, please buy my RECs and give me a better price. In many ways, the renewable energy producers in that model were price takers because they were going to the local electricity purchaser and asking them for a price and getting maybe a slightly better one with the green attributes bundled in. As a number of markets have moved to the unbundled model where they're able to monetize the credits separate from the electricity, the separate market is providing a greater value for the credits. The fundamental problem there is they don't have transparency into what the credits are worth into future years. So they may understand that today, yes, I can get $12, $10, $600, depending on what you're talking about, but they don't really understand what it is in year 2, 3, especially years 4 and 5. And a big part of the business process we're trying to build is a way to transact those longer term contracts separate from the power. So really establishing the price trajectory on a forward and kind of future basis. And there's a lot of interest in doing that because that enhances our ability to then turn around and say to a lender, we can demonstrate what the credits will be worth. We are able and capable to sustain a higher cash flow and borrow more money, do more projects.
Yeah, and in terms of the different REC markets, actually New York has a separate grid. It's one of the few markets on the East Coast that does not trade. We wish it would. That would be a great thing. But there are differences within the programs. No doubt a national market would make it more fungible. Without that, there is a certain level of fungibility within the grid. So for example, if you are a renewable power producer in Maine, you can sell your power to a Massachusetts utility because you fall within the NEPOOL region. And within those regions, there are standards. Admittedly, there are no standards across the grid levels, but that's the same thing with power. I mean, if you're generating power in ERCOT, you can't sell into PJM anyway. This is going to follow the development of the power market. One interesting thing as well is that from our customers, like a lot of the investment banks and hedge funds, they actually don't mind if the market's fragmented. They make more of a spread. So, there is a give and take. I mean, the bigger market will increase volumes, but will lower transaction revenue. Still, for us as a transaction platform, we want to see the larger market happen. But no doubt that is an issue.
In the absence of the larger market, are you capable of using your platform to trade 5 or 6 or 7 or 8 different regional REC credits in a profitable way going forward?
Yes, we are. It does not matter what the underlying REC is. The technology platform, the process we put in place for counterparty credit risk, for contract standardization is all exactly the same. The underlying REC is not an issue.
Okay, I'm actually going to move to the next because we're running up against some time. So thank you, you guys are great.
I'm Eileen Serco, president of Fiberite, and I'm here to talk about our business model. We are producers of alternate fuel through waste management. And what does that mean? Specifically, we take trash and we turn it into biofuel. What we do is we process the non-recyclable components of municipal solid waste and turn it into cellulosic ethanol and other valuable co-products on a very cost-effective basis. And I think it's important to understand what we mean by non-recyclable. All the paper, metal, and glass we're not interested in. We're interested in the 60% that's food waste, that's contaminated pizza boxes, yard waste, all the organic stuff that's currently going into landfills. And to give you an idea of the order of magnitude, there is over 102 million tons of non-recyclable trash disposed of each year. Our processes, which convert a ton of waste into 85 gallons of biofuel, has the potential to unlock over 9 billion gallons of renewable fuel. This is a blockbuster. And we are not only solving one problem, but we're solving 2 big problems as a double investment play. The first is the government has enacted through the renewable fuel standards mandates for the petroleum companies to purchase large volumes of renewable fuel. I'll go into that a bit more. Secondly, we offer an alternative to incineration and landfill disposal for a big portion of the waste stream. If we look at the renewable fuel standards, next year the government is mandating 250 million gallons to be purchased by the oil companies of cellulosic, increasing to 16 billion gallons by 2022. This year there's less than 5 million gallons of cellulosic ethanol. And that's our market. We're not the corn ethanol, we're not the biodiesel, we're the cellulosic ethanol producers, and we're one of the first in the country to be able to tap this. And there are cellulosic ethanols produced from other feedstocks, ag feedstocks, forest waste, but there are some restrictions on how you do it with municipal solid waste, and that's the core of our IP. As far as the opportunity in the investment with the waste business, this is a $75 billion industry where currently if you have communities paying $30 to $80 a ton to dispose of their trash, and we can turn around and create a value proposition where we're making that trash be worth $200 a ton, that's a huge differentiator. And I think it's important to say, you know, waste to energy or waste to fuel is probably, we're not the first to talk about that, but we're the first to be able to do it successfully with the biochemical route. And that's a big differentiator. There are older technologies that use acid hydrolysis or high cost arc gasification that have problems because basically they're heating trash, which releases toxins and contaminants, or they have tremendous CapEx infrastructure costs because you need special metal alloy vessels to handle all the acids. And so by going to a biochemical route, it's a big differentiator. And so you might ask, why hasn't anybody done this before? Well, 2 or 3 years ago, enzymes were costing $70 a gallon. They're now down to 50 cents a gallon, and there's been huge breakthroughs on the biotech sector that make the economics fundamentally different. Next, we're able to unleash value from 4 segments of the trash stream. It's not just the organic fraction that we're using enzymatic hydrolysis and fermentation to get to low-cost cellulosic sugars and then on to biofuel. We also are able to take our wastewater from the process and use it to fuel anaerobic digestion. There's a lot of soluble sugars in the wastewater. And so by using that to create methane, to create steam, we generate energy to run our plants. So we aren't a consumer of energy, we actually have modeled that we will be a net energy producer, which is a big deal. Third, the plastics fraction, we have 2 options. We can either recycle the plastics that we pull out from our processes, or we can use and bolt on a low temperature pyrolysis process to unleash the hydrocarbons to get energy from that. And then finally, in the black bag trash we're taking in, there are small remnants of metals and glass that our fractionation and sorting processes pull out that we can sell for added revenue. I won't go through in detail the 12-step process, but I will tell you our patents are in the front end, are in the processing of the waste, the sorting, the pulping, the washing, the sterilization, the removal of the ashes and waste that enable the enzymes and the bioorganisms to convert the sugars. We have partnered with a UK company, TMO Renewables, who has developed the best in the world of a thermophilic bacterium, TM242, which what it does is it allows conversions of the C5 sugars. And that's a big deal because others who have been out there have been able to convert C6s, but you need to convert both the C5 and the C6s to get the yields. And so we have an exclusive license for waste with the TMO bioorganisms for the US. A bit about our competitive differentiation. We totally avoid the food versus fuel debate that other biofuels have because there's no land use issues. Unlike switchgrass or mycanthus, there's no land use, we're using a waste. Next, trash is everywhere. We need communities of about 100,000 to produce enough trash for our biorefineries. Trash is everywhere, it's ubiquitous, there's no seasonality, so we have guaranteed feedstocks. Third, the waste business, there's already trash trucks picking it up. So there's no new infrastructure needed for the delivery and the logistics of the feedstock like other competing energy or ag crops. So the trash truck, instead of going to door A for the recycling, goes to door B to one of our plants. Our mass and energy balances have proven that we reduce greenhouse gas emissions 80% over petroleum fuels, and so we are far beyond the test for being certified as a renewable fuel. And then because we've chosen a biochemical route that goes through the pathway through a sugar platform, we actually have ultimately more flexibility in our final product choice. We've chosen cellulosic ethanol because there's a huge market and there are mandates that support pricing at $3 a gallon, but there's no reason we couldn't later make succinic acid at $6 a gallon and bolt on a chemical end, or make other alternate biofuels like biobutanol. So we have big flexibility given our choice of route in our conversions. And then finally, the big thing that's a differentiator from other competitors is with trash, you can lock in 10, 15, 20-year feedstock agreements. And so because we can lock in feedstock prices and we can actually harvest energy from the trash, we don't have the variability in energy prices that killed the ethanol business a few years past in the corn ethanol. So those are the big differentiators when you're looking at waste to energy. Our patents, we have approved patents, and in the US we have our international patents in the works. Our biotech partners are TMO and Novozymes, and we have a basket full of other relationships with the National Renewable Energy Lab, a couple of universities, and a host of other equipment manufacturers who are key to building our knowledge in this 12-step process. So if you're an investor, what are the dynamics and what are you really looking at metrics-wise on why invest? And I think it comes down to two things. The first is, what's your conversion yield? How many tons of feedstock can you take to convert and get gallons of biofuel? And at 85 gallons, where we've proved it out at an industrial scale, that's a good yield, and we think we'll ultimately get to 90 or 95 gallons. The next is what's your cost per gallon? And our demonstration plant that we have open in Iowa by the end of next year will be making cellulosic ethanol for about $1.60 a gallon. We're able to sell it at $3 a gallon. We think our first greenfield plant will be less than $1 a gallon. So there's huge margins if we're able to proceed. And I guess what really gets the investors excited is when you look at what our costs are to get to the sugars. And when you factor in the recycling revenues and the revenues from the tip fees, we can produce sugars for less than 2 cents a pound. And by comparison, that is 3 times lower than Brazilian sugar cane and 10 to 20 times lower than energy crops. Our founder came out of the waste business, sold and built the biggest recycling company in Washington. We have a 3-year operating history for a pilot plant in Virginia. We purchased a year ago a former corn ethanol plant in Iowa. We retrofit. So we aren't bench scale, we're at industrial scale with 3 years of operating history. And so our advantages, we're the first to have proven this conversion technology. We've been given the seal of approval by governments. We've secured a $2.9 million grant from Iowa. We're shortlisted for a DOE grant, and we're in the works for a $12 million USDA loan. So we're well on the way getting the government funding to match, and we have a deep history of understanding. And so with that, we're at the stage we're looking for $5 million to match our grant money. And I appreciate this opportunity to talk to you about how to turn trash into biofuels.
Thanks, Lenny.
Do you require the municipality pay a tipping fee to offset some of the capital costs to make the business model work?
No, our revenue models, because we have, are not built on having to have tip fees in them. They are, above a 25% IRR without tip fees. We're in the 60 to 70% IRR range if I can include a $30 to $35 tip fee range. And so the economics work without it. You layer in tip fees and it's you know, the returns, the project finance people are circling, and they're like, as soon as you get your plan in Iowa up and built and run it for 6 months, we want to do dozens of these. So
Yeah, that was my only other question. I mean, this sounds just incredible, but to what extent have you tested the reliability over time of the processes? I mean, the enzymes are new all the time, so there's no problem with those. There's no membrane or anything like that. Are there any significant risks in the reliability over term of the plant that you would construct?
Well, I think you hit upon it. When you're dealing with securing waste agreements, you know, politicians don't get elected if they don't plow the streets and you don't pick up the trash. And so to get the municipality feedstock agreements, you got to have robust equipment that takes trash every day. You can't say, no thank you, I don't want your trash, our plant is down for 3 days. So you got to make sure you've built a robust system. And I think that's our approach, why we're different from other biofuel companies who've started on the biotech route. Our guys are trash guys, and they know what 1,000 tons a day trash looks like, what you got to do to process it, how to keep the tip floor clean. And we started from that point, and the point has been in bolting together this dependable, robust equipment to process it on the front end. And that's the real differentiator that's gotten a lot of folks excited, is we're not protecting science patents as much on the bioorganism side. We've partnered with the guys who are the specialists in that. What we've done is focused on who are the 20 equipment manufacturers. We got to buy the equipment that we make sure that autoclave or that pulper doesn't break down when we need it to work. And so that's why the secret to this model is we've got a plant, we've been retrofitting it, we're raising the $20 million between the USDA and the DOE money. We need a little bit more private equity to get the plant finished and move our front-end operations in Virginia to Iowa. We need to operate it for 6 months or so, have proof of it, and then we have in the wings, we have a big oil company who's lined up, wants to go, thinks this could be a $500 million business model in a year or two. We have a big waste company that controls a ton of Northeast assets. They're doing their due diligence, and we have a big Asian investor who's all over the China markets, who has locked up feedstock agreements in Shanghai and Beijing, who is anxious to do this internationally. So our key is get the money raised to finish the plant, operate it for 6 months, and we think, you know, it's a whole different ballgame as far as the ability to make this be a real blockbuster company.
And I assume you have a very low emissions profile.
We actually emissions is very low, and so permitting isn't bad at all for these because it's all closed loop.
Yeah.
And it's a biotech, it's enzymatic, so there's not a lot of emissions.
Can you survive $10 oil?
Can we survive $10 oil?
Yeah. If oil goes back to $10, will you keep as your model one?
$10 a barrel. Well, I think so, because I don't think the government's going to retract the decision to force and mandate that the oil companies purchase a percentage of renewable fuels. I don't think the drive away from foreign oil is ever going to go away, regardless of what pricing. And the renewable fuel standard, what it did is it guaranteed renewable cellulosic producers a floor price of $3. So oil could go to whatever it is. There are government mandates in place that say, oil company, you have to buy X gallons, and here's the price, because it fluctuates off the price spread off of gasoline. So we're guaranteed actually a floor price. I mean, it's a complicated way, the whole pricing mechanism, but the government did that precisely so the investment community would come in.
I had a couple of questions on the variability of your feedstock. So how do you handle a stray propane bottle or a bottle of pesticides?
You know, it's the dead dogs. It's no different than, you know, that's the whole key, is others can make biofuel if they have homogeneous feedstocks. Our shtick is black bag trash. Our guys who ran recycling plants. And it's a series of, you know, there's some manpower involved in picking out what they call the bigs, the refrigerators and the big stuff. And then there's mechanical sorters and pulpers, and then there's magnets, and then it goes through, you know, a long process of degree of refinement as far as the front end screening. And so our guys are like, it's no different than what we did in the recycling side, but then you got to layer it on once you get the organic mush and you've separated out all the big stuff. How do you get that mush renderable for the enzymes to be able to digest it? So
that's part of your IP that you were referencing. Yeah. And my second question, your business model, is it to license or build, own, operate?
We are into a deployment strategy where we partner with the refining capabilities, the oil company for the back end, and we partner with the waste companies for their feedstock assets, and that we would have a piece of ownership and go out and project finance each one of these models. We've been also approached about a license arrangement on the international markets. So I think we'll probably deploy in US, license abroad.
What's the energy content of cellulosic?
Of a trash?
Yeah.
Not being the organic chemist, I'm going to give you the layman's answer. If you think about trash, the paper and the stuff that's contaminated, it's already been processed once, so the sugar content and the ability to get at it is a whole heck of a lot easier than wood waste and switchgrass. So I don't know whether it's double or triple, depends what comparative feedstock, but trash itself is very rich in organic content and higher than the ag and the energy crops. So the issue is you can get at the pulp. And so it's about
higher than corn, ethanol.
Well, corn, it has more sugar content, but you got to do more to get it. And there's hemicellulose and lignin, and different feedstocks have different amounts of sugars. But by and large, you can't compare cellulosic ethanol to the corn ethanol. You have to compare it to other cellulosic feedstocks, which is the energy crops like switchgrass, mycanthus.
I just want to know if I can fill my car up with it.
Oh yeah, I mean the test vehicle, we made ethanol and we filled the test vehicles that were the one in front of the Capitol there. Because ethanol our ethanol is no different than the ethanol that's currently going into the gas tank. It's 10%. It's identical compositionally. So it's the same. It might, instead of being green like corn ethanol, cellulosic ethanol from trash is sort of light brown and has a slightly different odor. But it works the same. It's got the same, energy composition, and the trucks just come to the plant and they top off the tanker for the top 10%. I mean, the delivery back end is, we've got off-takes with all the typical,
And are emissions lower than?
The emissions of the fuel, or, I mean, ethanol emissions versus gasoline are lower.
I just meant your ethanol.
It's identical compositionally to corn ethanol.
Wow, that is magic if you can do it. If you can pull that off.
Yeah, so we're just in the gap fundraising.
I'm going to take one question, and this is the only question that's standing between you and food and drink. So make it good.
That's a lot of pressure. I just want to repeat the question. It's basically, how defensible is the IP?
And we've taken the approach, we're not going to ring the fence and fight the world on the IP. We have some good, strong patents approved, but this is a first mover. You make your money on the first 10 or 20 plants, and it's about feedstock control. So we'll get in there, partner with the guys who control the feedstock, and we'll be the first to deploy 20, 50 plants and be able to protect our processes for a while. And we have the license agreements with TMO, which does have, heavy-duty patents for their bioorganisms. But again, I think it's something, there's too much money. I mean, there will be other entrants in this category over time.
The enzymes, you don't have exclusive rights to the enzymes.
Yes, we have exclusive rights to the TMO bioorganism, which is the fermentive bioorganism that turns trash and gets us the C5 sugar conversions. On the enzymes, so it's two pieces. There's enzymes that do the front piece, and then we have the bioorganism that ferments the additional sugars. So we use less enzymes. We're agnostic about the enzymes. There are 4 or 5 different enzyme companies that we can use, so we're not going to get gouged long term on the enzymes. But the bioorganism, which gets the yields to where you really are making money, that we do have US protection for that license for an exclusive.